You did everything right. You paid on time. Every single month. You never missed a due date. You even paid your full balance, not just the minimum. So why did the bank say no when you asked for a higher credit limit? The answer has nothing to do with your payment history, and by the end of this video you'll know the exact hidden number that decided your fate before you even hit submit. Meet Sarah, 29 years old, marketing job, good salary, never missed a payment in 4 years. One morning she opens her banking app and requests a credit limit increase. Simple click. She's confident. Her credit score is 740. Almost perfect. 2 minutes later, a notification pops up. We're unable to approve your request at this time. No real explanation, just denied. Sarah stares at her phone in disbelief. She's done everything the internet told her to do. Paid on time. Kept her score high. Used her card responsibly. So what went wrong? What Sarah didn't know is that banks don't just look at your score. They look at something else. Something almost nobody talks about. And it's coming up in 60 seconds. Most people think credit limit increases work like this: good score plus on-time payments equals automatic approval. That's what YouTube tells you. That's what your bank's website hints at. That's what feels logical. But here's the twist. Banks don't approve people. They approve risk profiles. And risk isn't just about the past, it's about prediction. Banks are asking one silent question every time you apply: if we give this person more money, will they be able to pay it back not just today, but in 6 months, even if life gets messy? Sarah's score said safe, but something else in her file whispered risky. Stick around, because what triggered that whisper is something 9 out of 10 people are doing right now without knowing it. Here's the piece nobody explains clearly. Credit utilization ratio. It sounds boring. Stay with me, because this one number quietly controls your financial future. Your utilization ratio is simple. It's how much of your available credit you're actually using. Sarah had a $2,000 limit. Most months she spent around $1,600 on that card before paying it off. That's 80% utilization. To a bank, that doesn't look like responsible spender who pays on time. It looks like this person is close to their limit almost every month. What happens if their income drops even slightly? Even though she paid in full every time, the bank saw someone living right at the edge of their credit line. And here's the part that stings. The safe number banks want to see? Under 30%. Sarah was nearly 3 times over that. But utilization alone isn't the full story either. There's a second factor. And this one is even sneakier. A few weeks before her application, Sarah did something that felt completely harmless. She applied for a store credit card to get 10% off a purchase. 2 weeks later, she signed up for a new phone plan that required a credit check. Each of these created something called a hard inquiry on her credit file. 1 inquiry? No big deal. But 2 inquiries in a short window, right before asking for more credit? To a bank's algorithm, that pattern doesn't say smart shopper hunting for deals. It says this person might be seeking credit from multiple places because they need cash flow. It's not personal, it's not fair even, but it's how the system reads behavior. Sarah had no idea those 2 harmless applications were quietly working against her. And there's one more factor, the one almost nobody mentions, the one buried inside the bank's internal model. Banks also study your income-to-debt ratio, not just your credit card debt. Everything, car loan, student loan, rent obligations reported anywhere, any other credit lines. Sarah had a modest car loan. Nothing crazy, but combined with her credit card usage, her total monthly debt was eating up a large slice of her income. To her, it felt manageable. She never missed a bill. To the bank's model, it looked like this. This person's income is already stretched. Giving her more credit increases our risk if anything changes. Here's the uncomfortable truth. You can be a perfectly responsible person and still get flagged as risky because banks aren't judging your character, they're judging probability. And that distinction changes everything about how you should approach credit. So what actually works? What did Sarah do next? That's where this story takes a turn. 3 months after her denial, Sarah didn't give up. She got curious instead. She called her bank and asked one simple question: "Can you tell me what factors go into a credit limit decision?" The representative couldn't give exact numbers, banks keep that private, but she pointed Sarah toward 3 things: utilization, recent inquiries, and overall debt load. That single phone call changed everything. Sarah made a decision. For the next 90 days, she was going to play the game the way the bank actually plays it, not the way social media told her to. And what she did next is so simple, most people overlook it completely. Step 1. Sarah stopped waiting until the due date to pay her card in full. Instead, she started paying it down twice a month, once mid-cycle, once before the statement closed. Why does this matter? Because banks report your balance on your statement closing date, not your due date. Most people don't know this. By paying mid-cycle, Sarah's reported balance dropped from 80% utilization down to under 20%, even though she was spending the same amount. Step 2. She stopped applying for anything that triggered a hard inquiry. No store cards, no pre-approved offers, nothing for 90 days straight. Step 3. She let her existing accounts age quietly in the background. Untouched by new applications. No drama, no tricks, just quiet, boring consistency. And 90 days later, she tried again. What happened next is the part everyone watching this video needs to hear. Sarah opened her banking app, same nervous feeling as before. She tapped Request Credit Limit Increase. This time, the response came back almost instantly. Approved, not just approved, her limit was increased by more than double what she originally asked for. Same income, same job, same person. The only thing that changed was the story her numbers were telling. Here's the real lesson hiding underneath all of this. Banks were never judging Sarah as a person, they were reading a pattern. A story told entirely in numbers, utilization, inquiries, and debt load repeated month after month. And once she understood that story, she learned to write it herself. This is the part almost nobody teaches. Credit isn't about being good with money in some abstract moral sense. It's about understanding exactly what the system is measuring and giving it what it's looking for. That's not manipulation. That's financial literacy. And most people never learn it because banks don't advertise it. Why would they? A confused customer is a profitable customer. If you take one thing from this video, let it be this. Before you ever request a credit limit increase again, check 3 things. First, your utilization, try to get it under 30%, ideally under 10%, right before your statement closes. Second, your recent inquiries, avoid applying for anything new for at least 60 to 90 days beforehand. Third, your total debt load, pay down what you can, even small amounts, before asking for more. Do this, and you're not gambling on approval anymore. You're speaking the bank's language. Sarah's denial wasn't the end of her story. It was the beginning of her understanding how money really works behind the curtain. And now you understand it too. If this video just changed how you see your own credit, hit subscribe, because next week I'm breaking down the one credit card mistake that quietly costs people thousands of dollars a year and almost nobody notices it happening. Drop a comment below. Have you ever been denied for something you thought you deserved? I read every single one. See you in the next video.